Hello everyone, and welcome to our second webinar of the day, or at least it's the second one for David and I, but it may be your first. So wherever you are in the world, you are more than welcome to join us. And I know there are a lot of people from the States. Oh, can you see that? Hold on. You shouldn't be able to see that at all. No? Oh, I do beg your pardon. As always, it's been one of those days actually. We've managed to lose one of our lines, our phone lines. Oh, that's it. Sorry. We've managed to lose one of our phone lines today. It keeps dropping out, and we've already been told that there's an issue on this one. We think it's something to do with the hot weather. We're not used to it here in the UK, and it's beautifully hot. A bit scorched down here where we live in the New Forest in Hampshire, but still lovely. So welcome. And if we do have an issue, GoToWebinar will tell us, and we may have to, if we go off air for a bit, please just wait, and it usually rectifies itself fairly quickly. This is us. This is where actually we are at the moment. This is the front of our education site. But before we actually start, let me just quickly, I know you've seen this many times before, not just in our webinars, but lots of other people's webinars, and that is the disclaimer. As you know, trading carries a certain amount of risk. You should always be aware of that risk. Please don't ever use money that you can afford, that you can't afford to lose. And in some markets, you can lose more than you originally started with. Although, as I said this morning, here in Europe, UK, and Europe, the new ESMA regulations have actually made, there's been some changes to the kind of when you get a margin call. Basically, they're not going to wait until all your money has gone, but we'll see what happens with that. Okay, so welcome. As always, I'm joined by David. In fact, this morning I didn't even allow him one word until I'd gone through everything. So but before I start, let me just pass over to David so he can say hello as well.
Thanks, darling. Sorry, I was struggling to find my on-off button. Very warm welcome to you all. Lovely to see you all here this afternoon, UK time. I know you've come in from all over the world, so wherever it is where you are, a very warm welcome. This session, we tend to focus on other markets rather than Forex. Obviously, Forex is one, but here we spend more time with commodities, indices, stocks, and looking at the broader markets more so than Forex. In terms of platform, again, we'll spend longer probably on the NinjaTrader platform, but Anna's got the MT5 running, equivalent to the MT4, and I've got the NinjaTrader platform running on my system, and we'll flip-flop between the two. And really, I suppose what this session does, it encapsulates the concept that volume price analysis can be applied to any market, any time frame, and if you have an understanding of volume and price, then really the world's your oyster, because you can apply it to any tactical approach to any particular instrument in any particular market. And really that's the foundation message, if you will, of all these sessions. And thereafter, the quantum tools, the indicators are there to help support, guide, and everything else, and give you the information that you need to help you make your decisions. If you do have any questions, please just drop them in the chat box. We will try and answer them at the end, sort of as a group, rather than as we're going along, because it tends to break us up a little bit. If they're short questions, we'll answer them in the chat box. If they're longer ones, we'll try and answer them on air for you, so no problem at all. I'm going to pass back to Anna, and we'll get going.
And just to pick up from what David is saying, and just to give you a sort of very, very quick and general overview, and I mean a general overview because we've got 10 minutes before the US markets open. And that is what we hope to achieve in this series of webinars. And very broadly, we are going to be looking at charts and obviously different markets. But as David says, the market itself is, I wouldn't say it's from a technical analysis point of view and from a VPA point of view, it doesn't matter for us whether we're looking at a spot Forex chart or we're looking at a commodity or looking at a gold chart. A chart is a chart. The only difference is the ticker symbol on the top left of that chart. But the reason we want to do this is we want to try and convey to you is that by looking at different time frames and looking at the structure of a chart in the time frame that you are looking to take a trade, but also in a slower time frame, we want to look at the price cycle, and we look at the price cycle as based on Wyckoff principles. And this is why I've actually got a slide from our quantum trading education program. It's actually a Forex trading program. And I had an email from someone who says, well, I'm not really interested in Forex per se. I understand that, Forex, I have to understand about exchange rates and the impact that they will have on commodities and equities, et cetera, et cetera. There's a whole reason why whatever you trade, whatever you invest in, you should really have keep a close eye on what the exchange rate is, and at least know what the forex market is there for. Is that a structure of a chart? This is highlights what we call Wyckoff's second law of cause and effect. But the reason I put this up is because this is typical of a price cycle, in the sense that obviously there's been some reversal here on at the bottom left of the chart. We've had a trend higher, then we've had consolidation, a distribution, we've had climatic volume, and then the price rolls over and we go back into a trend lower, and then the whole process begins again. We have accumulation and a buying and climax, and this price cycle happens again and again and again across all the time frames. We will have a look at it in real time on a Renko chart where we don't actually have time. We'll see it on a time-based chart. We'll see it on a weekly chart. We'll see it on a monthly chart. And once you understand, first of all, where the price has been coming from and where it is at the moment, you will also gain, through VPA, a pretty good understanding of where the price is going next. It's what Elliott wave traders try and do with their wave analysis. Now, that's all, that sort of information is pretty much out there. It's covered in detail in my books on Amazon, both in the original books and in the books of worked examples. But we also take it one stage further, because we talk about something called the C state, because during the price cycle, for example, when we have this trend moving higher, nothing moves in a straight line in these markets. You can see it moves up, then it pulls back, then it moves up a little bit more, pulls back, and then it goes up again. David and I have come up with a way of describing the different types of how price action can, what am I trying to say here? I'm trying to describe it as a C state. So for example, when we talk about a trend, you can have a trend with momentum, you can have a trend with momentum and volatility. Now they're both a trend going up, but they have very different characteristics. So every element of the price cycle we have broken down into what we call their C states, and we've given them their descriptions. And for those of you who don't know what the C states are, I've not come across them because they're featured primarily in my binary options book, which you may not be interested in binary options, but this is where we came up with this concept in the first place, and we carry it forward in the Forex program. So what we call these C states, we have a trend. We have a trend with momentum. We have a trend with volatility. We have a trend with momentum and volatility. Then we have congestion without volatility, and we have congestion with volatility. And obviously this is congestion with a lot of volatility because it actually happens at a climatic top, and you will see the same again at a climatic bottom with accumulation and buying, because this is where the market makers are primarily involved in moving the market in the direction that they want to. Where you have congestion here, perhaps in a pullback, you're not going to get so much volatility. Now, you could ask yourself, well, why do I need to know all this? Why should I look at my chart in this way when maybe I've got indicators that will help me to do it, which is fine. Maybe you've got Fibonacci, you've got moving averages, maybe you have some of our proprietary indicators. And the reason for doing this and understanding this approach to the price cycle, and then having these descriptions of the different elements of the price cycle, is because it will help you in putting together the kind of tactic that you like to trade. What is your trading tactics? First of all, it will identify what kind of C state, where you are in the price cycle on the chart that you normally take the trade. How does that compare with perhaps the slower time frame? Because you'd always compare the chart that you're going to take the trade on with a slower time frame, because what could be happening in the slower time frame could be very different to what is happening on a faster time frame. And on that faster time frame, so for example, your slower time frame, which could be the hourly chart, it's the instrument is in a trend, a trend with momentum, and you're perhaps looking to join that trend. What are you going to do? You're going to go down into the faster time frame and perhaps see where that opportunity, where is that setup going to occur? Well, it's obviously going to occur in some kind of reversal, some kind of pullback, because on the slower time frame, it's still in a nice upwards trend, and you want to get in at a good at a good point. But more important to that is this issue of risk. If you are going to be trying to take a trade in a market where you are in a trend and it's got some momentum, but it doesn't have a lot of volatility, what is the risk on that trade? What is the risk profile on that trade? Where are you going to have to set your stops? If instead you are going to attempt to take a trade when a market is in a congestion and in a congestion with volatility, how do you think that is going to affect the risk profile of any potential trade? It doesn't mean you can't take a trade, but you have to be aware that the risk on the trade is that much higher, and to allow for that risk, you are going to have to set your stop loss that much wider. You could be perfectly correct in your assessment of what is happening in the price cycle and what is likely to happen next. But because of where you are in the price cycle, and because of the C state of the that is going on in the price cycle at that particular time, you may be taking on far more risk. And if you're going to take far more risk, but you still want to go ahead, you're going to have to allow for that in your stop loss. So that's what I wanted to say. Now, this is all well and good. This is the theory. You can see the chart here, and you think, well, how does that actually relate back to actual charts? And it's very, very simple, because what I have here is a typical workspace that I have for the MT5. And the reason I like the MT5 platform is for a number of reasons. First of all, you have lots of different instruments that you can trade. I've got the dollar index as the index, as a derivative of the actual futures contract. But more importantly on this one, certainly if you're into Forex, is it offers the 8-hour chart. And if you have the opportunity to set up the 8-hour chart, I would strongly advise you to do so, because what the 8-hour chart is, particularly for Forex, it is a 24-hour market, but each session is very, very distinct. And what I've got here at the moment is I've got the euro dollar. This is the session that's just gone. The rollover in time is at 2 o'clock our time. So this is now, we're half an hour into this candle on the 8-hour chart. And you can see there's heavy selling of the euro, heavy selling of the euro and some buying of the US dollar. That is because Draghi has been speaking. And sort of quite unusual, that's actually now being carried on into the US session. It's certainly slowed down compared to what's been going on before, but you can immediately see that first, if you're not aware of these crossover sessions, particularly for Forex, you can get caught out really, really badly. So this was the Asia session here, where obviously it went up, then there's some weakness came in. It actually carried through this morning. The euro's been selling off ahead of Draghi, and now we have this continuation. But what I really wanted to show you was an example of what we looked at there. And this is the euro dollar, and I want you to focus on this area here, where we can see where we had this is a 30-minute chart where we can see where we had a distribution. We have our support and resistance. Support and resistance, by the way, is what is going to help to, if you like, give some geometry to your chart. And we can see here 1742 was obviously the top here. It has never managed to get through that. So we know forget what's happened here, we can see here there was a sort of a distribution very similar to what we saw on the schematic, and it was a case of them waiting for the price to roll over. Now we've had this volatility come in. That's obviously again because of Draghi, and what the support and resistance does is, where is it heading next? Well, the next line of support, or reasonable support here, is across at 1667. But you can really see how this plays out on a Renko chart. And I want to move back to some yen pairs that we looked at this morning, because on a Renko chart where you don't have time, you're just looking at price action, the C states are much more clearly in evidence. So obviously we have them move lower, then we had the little pullback higher, and now we are really in a very, very strong down move. We always use the Renko in conjunction with a time chart, and here I have the 3-minute chart. What's significant with this break has been the break of the S4. We have a product, we have an indicator called Camarilla. These are levels that we use, as I said, to really help define the structure of the chart even more in terms of important levels. The S4, from a Camarilla perspective, is a break through the S4 on strong volume, is really taken as a could be a valid breakout. But you can see here volume, actually that's a very big bar. Look at the volume underneath there. Is that, although that's broken through and closed off, I'm not sure that is actually going to carry on further, because we've actually got some buying coming in. And what we have also is we have our CSI, where we have deconstructed the forex market into the individual currencies. And the reason I'm hesitant about whether the euro dollar is going to carry on lower, it doesn't mean it won't, is because the dollar up here, which is this red line, is actually reaching a point of overbought. This is the 12-minute chart, and this is the market of mean reversion. It always, it's like elastic bands. It pulls away, then it comes back, it pulls away, and it comes back, and that is what we are looking to trade. And I've actually got the there we are. This is a very nice chart. This is the 3-minute dollar index, which you should always have the dollar index up, and it's reflecting what we see on the euro dollar chart. We've got the shooting star candle looking to form at the moment. We've had this break of the R4, which is resistance obviously to the upside. So we'll see how that plays out. And before I pass over to David, let me just give you an example of what I mean by chart structure, as we saw on the price cycle, and the comparison, the difference in two pairs. The pair we looked at this morning was the pound yen. The pound yen is hugely volatile, very, very spiky. I wonder if I can, let me see if I can reduce that a little bit. Right, here we are. Right, this is a nice trend higher. If you look over to the left of the chart, you can see that that's pretty much the kind of picture we had on our, where is it here? There we are. If you look at that, I can move it over there. So you can see that. You can see the primary trend. We only had one little pullback in that trend higher. That's a nice smooth trend. It's fully supported by all our indicators. The trend dots are nice and blue. There's nice march up higher for the pound yen. So that's pretty, that's pretty consistent. Now, let's move down here. This is a trend lower. Let's say maybe from here, from this point here, and I say from this point here because this is when we have the trend monitor flip-flopping out of these colors, we know we're in some kind of congestion. There's a lot of whipsaw, choppy price action. But let's say from this point, we have a consistency. That, if you joined all those points up, you could legitimately say that is a trend low. We've got lower highs, lower low, and lower lows and lower lows. But look at how it gets there. It's constantly pulling back, moving down, constantly pulling back. Look at the difference between that move to there, and that move from there to there. If you begin to understand that, that was a dream to trade. This is not so much of a dream to trade. Doesn't mean it's not possible. But think of the emotion that you would go through. You know you're right. You know all your other indicators are telling you that the pound is selling off, that there's buying of the yen, but this trend puts you through the emotional ringer. Then we have a little counter trend. Then eventually we have a base down here. This was a nice little move higher, but look at the move that is developing at the moment. Would you even look to trade that? The answer is no, because it is going into a congestion. It's a congestion around the volume point of control. We know there's a lot of volatility because of the wicks to the candles that are part and parcel of that congestion. Now, if you compare that, and I promise I'm going to finish now, is with the Aussie that we looked at as well this morning. Let's have a look. Now, this is, again, we have a trend lower, but look at the trend lower, the difference that we can see there compared with the pound yen. So once you start to look at these charts, at any chart, in terms of its structure, in terms of the price cycle, what is the C state of that particular section of the price cycle that you're looking to trade, a lot of things start falling into place, and you will start to become more confident in actually reading what you think what is actually going to happen next. I think I'm going to stop there because the market has actually opened. I'm going to pass over to David, and as I said, just bear that all in mind. If you want, I did talk a little bit more about this morning. What we are doing with these webinars, they're all going onto the Quantum Trading YouTube channel and my YouTube channel. They're about an hour in length. So if you want to just refresh what I said about the start of this, just listen to the first 10-15 minutes and flick through the webinar and pick up the bits that maybe you want a little bit more information on. Right, that's how I'm going to stop, darling. Can I pass over to you now? Because really, for this session, we really want to go over to NinjaTrader. We want to go over and look at the indices, some commodities, and actually some stocks, in particular Facebook. I think David wants to say something. Oh, don't worry, you can just talk about it. There we are.
Just going to transfer over onto the NinjaTrader. Have you changing or me? I'll do it. Yeah, I can change it. There we go. Okay, should be coming up anytime now. There we go. I'll just move the chat box down a little bit, just out of the way. I wanted to start really just focus on the dollar for a little minute because it's actually had a decent move this morning, and certainly into the early part of the session. And clearly, as we're in the New York session, then the dollar becomes very much the center of focus. And indeed, as you move around the 24-hour clock, that is a facet of certainly trading Forex, but also the other markets. The focus on the 24-hour session is very different as you move from session to session. In the UK session, it's very much European currencies. Obviously, as we get into the New York session, the US session, it's very much around the dollar. So what I've got here is just at the top left here. This is a 5-minute chart of the dollar index. Alongside that, this is the yen index, again on 5-minute. And down here at the bottom left, I've got the euro index, and these are all the quantum indices. But you can also find these on investing.com just by heading over there, and you'll find them pretty much on the home page there. And basically, this just gives you a flavor of sentiment. It gives you an understanding where the dollar is. We've seen this a lot of positive dollar sentiment, certainly in the last sort of hour or so, and that's what's triggered a lot of the selling, and certainly in terms of the major pairs at any rate. And we're seeing that come to a bit of a pause here, but certainly looks bullish for the time being. In terms of the yen, it's pretty much flopping about at the moment. That wasn't the case, certainly in the Forex session this morning, where there was a pretty strong yen buying, certainly in the hour 20 minutes we were on air. And that's now gone back into its shell a little bit. And then down at the bottom here, what you're seeing in terms of euro, you're seeing euro selling very much in response to Draghi's comments. And over on the right-hand side here, I've got the VIX, which gives us a heads up on sentiment, certainly that will be reflected in the indices. So that's kind of the backdrop, if you will, of where we are, fast charts. And just before I forget, we do focus a lot on the faster timeframes. That's not because we believe that faster timeframes are the be all and end all. They're not. It just helps in showing the indicators in the education process. It's a much easier process to look at on a faster time frame than on a slower one. Let me just head over to, just want to show you the currency array, because what I've done here is I've actually isolated out the dollar. And I did this morning also, and in that case it was the yen, because what we were seeing in terms of the yen was universal buying of the yen. In other words, all the yen pairs were ranked at the bottom of the array. And what the array does, it gives you an instant heads up as to the sentiment for that particular currency that you're interested in. So here, as I say, I've isolated out the dollar. We've got it on 5-minute, we've got it on 10-minute, we've got it over on 15, and we've got it over on 30. You may not be able to see this, but down at the bottom, we've got the euro dollar. No great surprise. The Aussie dollar is still, the Aussie, bless it, is still being heavily sold. This morning it was being sold against the yen. Now it's being hammered against the dollar, and it is largely through a combination of both Aussie selling and obviously positive dollar sentiment. And that's pretty much reflected across the time horizons. The Aussie dollar here is right at the bottom. The Aussie dollar here is also right at the bottom. And it's also right at the bottom over on the 30-minute, although the trend there is not so strong. This angle of line here also gives you a heads up to the strength of trend for that particular pair in that particular time frame. So what we're seeing at the moment in terms of dollar, yes, we are seeing a lot of dollar buying, heavy selling of the euro, a lot of selling of the Aussie, New Zealand, and also pound are down at this level, and the same here, and the same here. To the upside, where the dollar is the primary currency, it's pretty much following suit. We've got the dollar CAD rising, we've got the dollar Swiss rising, and we've got the dollar yen up here. Over on the 30-minute, it's not so strongly reflective, but then if you appreciate that when you look across a time horizon, what you expect to see is that these sweeping up here, this a little bit behind because it's a slightly slower time frame, the same here and out to here, because if that trend develops across the time horizon, then ultimately these are going to follow the faster time frames up here and follow suit. And that is what you're looking at the whole time. But essentially what this is giving you, I'll get rid of that, go away, won't go. What this is giving you is a very clear and definitive statement as to what is happening with the dollar. Is the market universally buying the dollar? Is the market universally selling the dollar? And if so, which pairs are moving most strongly and which pairs are moving less strongly? That doesn't mean, for example, that a pair that is less strongly trending, for example, the dollar CAD here, which is not right up at the top here, it's got some way to go. But ultimately, this may well swing all the way up here. And of course, that is down to analysis of the chart. You'll be looking at volume price analysis, etc., etc. This array is also then clearly demonstrated on the ranking ladder, where you can see euro dollar at the bottom. These are all stacked up down at the bottom, and these are pretty much climbing up to the top and across the time horizons. If we move over to the, let's go to the stocks workplace for a moment. I've got 4 here, and I just pulled these up to really highlight 1 or 2 aspects of volume price analysis, and really just to demonstrate what I mentioned right at the start, is that it really doesn't matter what you're trading, whether you're an investor, whether you're a speculator, your time horizon, or your tactics. Once you have an appreciation of volume price analysis, you can pretty much take the ticker off the top of the chart. It really doesn't matter. It's a chart with volume and price, and you can analyze it thereafter. It's just one of those approaches which is so powerful and yet can be applied in any which way you choose. This is Disney. Just a couple of things that I wanted to highlight here. This is the daily chart for Disney. When you see these surges in volume, these, yep.
Somebody said they can't actually see your chart.
Oh.
Could you just ask if everyone can see?
Can I just ask if anyone can see my chart?
Audio.
The audio's fine. Yep. Thanks, Melanie. you should be seeing a pretty large daily chart of Disney with volume point of control on the right where my arrow is, trend monitor at the bottom, and volume at the bottom of that. Yeah, I think everyone can see that. Okay. And once you start to see high volume or low volume, you start to interpret it. And there's a couple of nice examples here on the Disney chart. The first appears here. Really just a classic example of how we look at volume and price, because what volume and price is about is identifying whether they are in agreement or disagreement. And is that disagreement telling you something? And is that agreement telling you something? And what's happening here is we had volatility appear with this triangle to the top and bottom. That's the volatility indicator on Ninja. So we've got volatility. We've got a huge surge in volume. This may well have been to do with earnings. I don't know. Can't remember. The following day, we get a nice surge up. We get some decent volume, and this looks as though it's going to continue. The day after that, we get high volume again, but a narrow spread candle. And what that's telling us from a VPA perspective, certainly, is that this market is looking a little bit weak, because what we should have seen with volume like at this sort of level is something that was equivalent to this candle. So we would expect to see the market rising up here somewhere. It hasn't. It's closed with a narrow spread. And therefore, we can infer that the market at that point is not looking strong. It's a signal of potential weakness. It doesn't guarantee the market is going to roll over or it's going to collapse or go side. It's just telling you that there is potential weakness because we've seen a huge amount of effort going into the price action and the price action hasn't delivered. In other words, we haven't seen an equal and opposite reaction given the amount of volume that's being driven into the market. We've had a pretty weak reaction in terms of price. So that gives us a heads up. It's a signal, it's an early warning signal as a volume price trader that potentially the market is looking a little bit weak. It's also reinforced by the fact that we've had this volatility candle 2 candles earlier. The volatility trigger, as I said earlier in the London session, it's a very powerful indicator because what it's telling, and it works in all time frames and it's triggered automatically, it works on average true range. So what it's looking at is whether the price action in that time horizon on that particular candle is outside the norm, outside the average. And if it is, then the indicator's triggered. And the reason it's powerful is because generally it's associated with insider market maker participation in whatever market you're looking at. And it's very clear here. We have this huge surge in volume, clearly participating, and the objective is to trap you into a weak position. It doesn't guarantee the market's going to reverse, and it doesn't guarantee that the market is going to go in congestion, but that's often what happens. And the reason for that is very simple, because a congestion phase puts enormous emotional pressure and stress on you as a trader to sit through it. I mean, this is a daily chart, so we're talking about weeks here. If you're an investor and you've seen this and you're now sitting in this, you may well close out, you might be stopped out, who knows? You may close out through the pressure of the emotion of sitting there and thinking, actually, I don't think this market's going to go any higher. So that was one very simple little lesson from that price action. And what we're seeing up here, certainly in the last week or so, we had this huge candle, big wick to the upside. The precursor was this one on not such high volume, but certainly when we get a follow through with this, tons of volume driven into that particular piece of price action, big wick to the upside, pivot to the top of it, narrow spread, closing well off the highs, lots of volume. Are we expecting strength or weakness? We're expecting a certain amount of weakness. It's not to say that that stock is going to roll over and suddenly a collapse. It's just telling you that we are likely to see weakness in that stock in the near future. This is another one, just pull forward up. This looks like a great trend, and it is a great trend, but the reason I put it here was it just gives you an example of a stock. We tend to think of American stocks as being tens of dollars and hundreds of dollars. We're familiar with Google and Apple and Facebook to some extent, all the rest of it, hundreds of dollars, and a price move in a day may be $50 to $100 on a volatile day. But here you're looking at a blue chip stock. It's Ford, dear old Ford. It trundles along, and if you're a little bit nervous as a speculative trader or an investor, it's just a nice example. I mean, the price move here from the top is, this is $12, and we're trading now at what? Just down to $10. The trend monitor here, it's a nice example. It's just held you in. You can see, you get these reversals all the time. And does this reversal look very strong? No, because you've got this very weak volume associated with it. You also have to remember as a volume trader that certainly in the seasonality aspect of it, you've always got to bear that in mind, because we always see volume decline through July, certainly July and August, and then it starts to pick up again in general as traders return in September. So we've got that weakness there, and the market has rolled again, and you can see here that Ford has opened gap down just about the $10. Yeah, I'm just going to pass. Do you want me to pass back to you? Yeah. Okay, I'm just going to pass back to Anna at that point.
I just wanted to jump in there with for David, because just a couple of things. First of all, I have got Facebook up. Now, the reason that Facebook has fallen, I will tell you why. As part of the our Forex program, we ran a Facebook group for our traders, and I have to say it wasn't the ideal solution. We used to have another platform for our chat and our get together, but anyway, to cut a long story short, we had to move to Facebook as a group. And yesterday I actually closed the group and moved us all back en masse to River, which is a management platform, and it has a chat forum. And David jokingly said to me, "Oh, do you think Facebook has fallen because all our traders have en masse closed their accounts?" I said, "Of course they are." Joking apart, talking about structure, talking about what I was mentioned earlier on the chart, and we look at this is, as I said, this is Facebook. This is a trend. You can see clearly there is a trend. Then we had a kind of pullback, but nothing really very major before we had a lot of buying coming in under this hammer candle, and it looked as though this trend was, the resumption of the trend. And what I said earlier, right at the beginning, I said, having an understanding of the price cycle, where you are in the price cycle, and with volume price analysis and indicators, either proprietary ours or your own, whether it's fibs, whatever you like, you like to use, it will help you determine. It will help to decide for you what is it that you like to trade. Do you like to trade a reversal? Do you like to try and trade a continuation of a trend, or do you like to trade a breakaway or a breakout? But unless you have this understanding of what is going on in terms of the chart and the structure of the chart, you cannot make that decision. And when you first start, the way to do it is to try everything. Once you've got this understanding, so do I like to be a reversal trader? Am I looking for those points in the price cycle, in the bit of the price cycle I'm looking at in my faster chart, where I think I'm going to get a reversal? And just to go back to euro dollar, and when I said I didn't think the price was going to go any lower. Why? Because we were looking at these two candles here, that candle, and the volume underneath it for the range, the spread of that candle. If that was a genuine candle with lots and lots of heavy pressure selling, that volume bar should be much bigger. And in fact, the wick came in, price support came in, and we've had this hammer candle pushing the price up. And although we did have a break of the S4, often with breakaway, that's why a lot of traders don't like using it, because it breaks away and it immediately goes back up and retests, and it's retested the S4 level once, because to go back through that S4, to go back up, if that's a genuine reversal, this is what it's got to break. It's got to break S4. And as I also highlighted here on the CSI, we've still got it looked as though the dollar was going to roll over. It hasn't quite. It looked as though it did, and it's stopped temporarily. But unless you understand what you're looking at in terms of a chart, how do you know, is that going to be a reasonable entry point? Is that going to change? And is it time for this reversal? We've got all sorts of information from our other charts. We've got the 8-hour chart, we've got the levels that we have on the 3-minute chart, we've got our 30-minute chart, it looks as though we are going to have to be patient. But because we understand VPA and because we understand about trends and we understand about trends with momentum, volatility, congestion, we knew that at this point here, at the very least, this move lower, which was a trend, which was I wouldn't say that had a reasonable amount of volatility, and because you had the wicks to the bottom of the candles and the tops of the candle because we had Draghi, we only had a little pullback. Let's see, what's happened, but at least you can make some logical decisions. Right, sorry, darling, that's all I wanted to say. I just wanted to bring that to a close at this point because now it's back to David with Ninja Trader.
Should be coming up now. There we go. Just move that out of the way. There we go. Okay, what I've done is I've actually switched screens away from the stocks. I've got 4 charts up here. This is on the NQ. We've got the NQ, this September contract. We're on the 5-minute here. This is the daily chart, top right. Down the bottom here, I've got a slightly slower time frame of the NQ, and over on the right-hand side here, I've got the VIX running on 5-minute. And as I'm sure you know, when the VIX is rising, then equities generally be falling and vice versa. So when you're trading, if you are trading indices or indeed if you're trading stocks, whatever it may be, on an intraday basis, certainly at any rate, and obviously on a longer-term basis as well, then the VIX is a key index to have up either live or certainly on a slower time frame for reference. You can see here what we've got here. We've got the VIX is clawing its way back, and if I just close it up, certainly on the daily, it's been testing this 11-12 region for some time. Now, what you're seeing right now is probably horrific because I'll pop this up full size. 2 things. First of all, every single candle bar this one has got a volatility trigger on it. So we are just seeing volatility on volatility on volatility piled in. Is this a particular chart you want to trade? No, have absolutely no interest in trading that at all until the market settles down. Just going nowhere. And let's be honest, Donald Trump, bless him, could issue a couple of tweets and the whole thing will go crazy and develop a strong trend in one direction or the other. That is something, it's a facet of what we have to live with as traders, which 10 years ago didn't happen, even 5 years ago. Now it happens monotonously, and it is often the case, and there's actually a case to be put for this, that breaking the session up into 2 halves, certainly the London session, you come to the end of the London session, this happens more than you would think. The sentiment in the London session is then promptly reversed by a move into the New York US session and the volatility that's associated with comments from the dear president. So it's interesting. It's interesting times. You've certainly got to be nimble on your feet. You've got to be protected with your money management, because if you don't, then you'll get cut to ribbons with the volatility that ensues whenever the trade wars go top of the list, or even Brexit to some extent. It's still up there with the news releases. If we drop down onto the 10-minute here at the bottom, just move that out of the way for a minute. Sorry, just bear with me a moment. Hold on a minute. I'm just going to switch off for a moment. Sorry, I just had a frog in my throat. I'll just leave that where it is for the time being. But again, you can see down here we've got volatility, volatility, volatility. And as I mentioned earlier, the volatility indicator triggers in real time. So it's already triggered the fact that we've got extreme volatility on that particular time frame. Over on the right here, we've had the VIX climbing, and that has been reflected in the NQ falling. Let's just head over to I've got the ES here. This is the ES, which is the index for the S&P 500. This is the futures contract. The NQ was the futures contract for the NASDAQ 100. This is the futures contract for the S&P 500, which is the ES, which is the most heavily traded of all. And I've actually got this associated with tick charts. And what's interesting about the NQ is that certainly over the last few weeks and months, the NQ has been leading the way. The ES and the Dow have been a little bit laggard in that respect. And what we've got here, we've got the daily chart for the ES, which gives us context. We can see that we've had the bullish trend. We had a little bit of a pullback over these 2 days, but the bullish momentum is still maintained, although it's not particularly strong today. And then these 3 charts are actually tick charts, which are non-time-based charts, and where we're getting the tick data from, or the tick settings rather, is over here with the tick speedometer. I'm not going to go into that in great detail, other than to say that where the color changes occur, it's showing you increases and decreases in tick activity in terms of what is going on in terms of that particular index. But down here, we have the traditional volume on the tick. So we've got a price chart here of 1 minute, 2 minute, and 3 minute, where we can apply volume price analysis in the usual way. So we've got price and we've got volume. And over here, we've got the tick charts for the instrument. I'm just going to, they're all running at the same speed at the moment. In fact, I'll change that to 2224. Just put a T on the end to change it to tick. This is 3294. And this one is 2708. There we are. Okay, so the 3 tick charts are running at the correct speed. And a tick chart is very much like a Renko chart. It's time independent. So what you'll see, it is one of the reasons why, as a scalping trader, you might migrate to tick chart trading, because you see raw momentum on the chart. When the market speeds up or slows down, you see that on a tick chart. You see it on a Renko chart. That's why traders like trading these particular charts, because you get a sense of the speed of the market. You don't see that on a time-based chart. All you'd see perhaps is volatility or the price action moving around quite quickly until that time chart closes off. But on a non-time-based chart like a tick chart or a Renko chart, you will see that revealed as raw momentum. And again, when you're trading tick charts, it's a multi-chart approach to the market, because it gives you a sense of momentum and also of the trend moving through your particular chosen time horizon. Did you want to add anything to that, Johnny? No? Okay. Let me just go back to... I'm just going to go back to the spot forex for a moment, because as I said earlier on, the Aussie has been under the cosh. It's remained under the cosh, and this is just, again, a nice example of using multiple time frames. We've got the 5-minute, the 15-minute, very traditional 30-minute, and over onto the daily. And you can see the trend monitor is bright red throughout. It's holding you in throughout this phase of very, very bearish price action for the Aussie, but it's also being driven on the other side of the equation by the dollar. And what's also nice here is we've got some really nice examples, again, of VPA in action. You can see here down at the bottom, as we come through into the US session, this massive spike in volume. The market, this pair, and I'll make the point, this could be a stock, it could be an index, it can be a currency pair, it can be a currency future, it can be anything you like. Because once you see this, the instrument, the market, forget that it's a currency for a moment, it's tried to rally, spike to the top, bang. The market is in this time frame on a 30-minute chart is closed well down. What is that telling you? This massive amount of volume is telling you one thing, that there is heavy, heavy selling at the moment in this particular instrument and this particular time frame. We've moved through the volume point of control here. That's what this yellow dashed line is. This is where we've got the heaviest concentration of volume, transacted volume sitting here. The trend monitor is bright red. We've got further heavy selling here. Be interesting to see how this particular candle closes off once it closes off on that particular time frame. But it's just another nice example of VPA in action. Of course, when you go up onto the 5-minute time frame, that 30-minute chart is a very different view of the 5-minute. Of course it is, and that's why we use multiple time frames, because what the 5-minute will tell you is much more quickly what is going on in your particular slower time frame, which is why we always use a multi-time frame approach. Just go and have a look at the 15. There we go. And again, this sort of candle, and this really reinforces the point that I'm making about using multiple time frames. When you see this candle on a 15-minute chart, and maybe you're on the 5-minute, actually overlaying 3 periods of time, in other words, 3 5-minute time frames to arrive at a candle like that is very difficult to do mentally. You can do it with 2. For example, here and here, you could overlay this candle price action with that one, and you'd come up pretty much with a candle that's gone up and come down. In other words, weakness under high volume. But when you extend that out to 3, it's a lot more difficult. This is a classic example. It's one of the examples we focus a lot on in the education program and the videos. Once a trend has started, particularly a bearish trend, your tactical approach to the market may be as a breakaway trade. In other words, you're looking for congestion phases, and then once that congestion phase breaks down, then you're looking to jump in and you're looking for the clues and signals. It's a very powerful tactical approach. It does require patience, but once the trend starts, you are getting in early. So that patience is rewarded, if you will. It doesn't suit everybody. And that may be a route that you want to take to market, whereby you focus on one particular tactic and you become an expert in that tactic. So all you're ever looking for in your chosen market is congestion phases. Now, to me, that makes a lot of sense because congestion phases constitute roughly 70% of market price action. The trending aspect is very limited. It's 25 to 30, broadly speaking. So if you're looking for a tactical approach which focuses on congestion, it's not a bad place to start. You have to be patient and you have to decide when you're going to jump in. But once you start to see a breakdown through these levels of support, once you see a candle like this with a deep wick to the upper body, the market is clearly rolling. It's got some bearish sentiment to it already. And then you see an absolute heap of volume coming in underneath here. This market is utterly fragile. And it's not a question of when it's going to break. It's not a question of if, it's just a question of when. On this occasion, it went on the next candle. It could have been here for 2 or 3 candles. It could have gone into congestion. But ultimately, this market is fragile and is going to fracture. It has to, because under this amount of volume, there's only one way that market's going to go. The next candle confirms it. You've got very high volume under a nice widespread candle. You've got very limited wicks. Wicks are absolutely key to volume price analysis. They are a fundamental, excuse the pun, they're a fundamental component to the construction of the candle, which is why we use candlesticks as opposed to bars. It's much more demonstrable. So what I said earlier on, what we're constantly looking at in terms of volume price analysis, we're looking for anomaly or we're looking for agreement. And here we've got agreement. The candle is wide, it's down, very narrow wicks to top and bottom, nothing to speak of, and we've got a ton of volume under it. That is merely confirming that. We get a little bit of support coming in on this candle, and then we get another signal of weakness. When you get these in a downtrend and you've got decent volume under it, they're only telling you one thing. This market is so weak, it's ridiculous. You're going to see further downside momentum. Yes, you've got to sit through this. We had some buying coming in here. This is probably buyers coming into the market thinking, okay, well, it can't fall any further because it's fallen to, maybe it's a fib level or maybe it's a 200 MA or something or the other. And they come in here and they're buying on the prospect that the market has fallen a long way and therefore it must reverse. Well, maybe it will, maybe it won't. Same again here, more patience. And ultimately, you've got the trend dot sitting there. You've got the trend monitor helping you as well to keep you in. And you're now moving down in terms of the volume point of control, which is what this histogram is up and down the right-hand side of the chart. This is the volume point of control itself, this yellow dash line, which is the maximum volume on the chart in terms of volume at price. Because what the volume point of control indicator does, it basically rotates the volume up onto this axis. So what you're looking at is the concentrations of volume where the price is, where the heaviest concentration of volume is, and where you've got these very thin concentrations of volume, like here, for example, the anticipation is that the market is going to go through there fairly quickly, because in terms of a concentration of volume sitting there, it's pretty lightweight. You can see here it's pretty low. What happened with the price action? It pretty much went straight through. The same applies down here. We've got very little in the way of volume sitting in these regions. So in terms of volume as a support and resistance mechanism, there's very little there. Now, obviously, you would look at price support resistance, which is the very traditional way of looking at a price support and resistance as an approach, which is what the accumulation distribution indicator does here. This is looking at it from a price perspective. But what the volume point of control does is it takes the volume, price, and time perspective where you've got concentrations of volume, because if you've got very dense volume sitting there, it's a combination of traders who've got weak positions, all sorts of other aspects. And if you have heavy volume in that area, the prospect is that the price action is likely, at the very least, to congest in that region. And if it's light volume, as we've got approaching now on this particular time frame, which is 15-minute, then you expect, your anticipation is that that price candle is going to move through there fairly rapidly. And we go down onto the 30, and that obviously reflects the same sort of principles as well. And you've got the daily chart here for context, which is, from a daily perspective, is horrid. Unless, of course, you're looking at this as a congestion breakaway trader, in which case more patience required. Or if it was a stock chart, for example, you would be looking at this as a potential opportunity for cover call writing, because you don't want to see strong trends. You want to see a chart that's in congestion with some mildly bullish momentum. Let's just pop that back down there. Are we okay for questions, darling?
Yeah, fine.
Yep. Let's just go back to, I'm just going to have a look and see what's happening in terms of the original indices. We've still got the dollar. You can see the dollar here. It's still climbing up, not hugely strongly, but it's still bullish. These two moving averages are part of the indicator. They come standard, and it just helped to give you a feeling for the market. The euro is bottoming out. Draghi must have finished by now, and the yen over here was still flatlining. Just going to have a quick look at commodities, everything going on there.
The gold chart, right? It's got a nice thing on the what's happening in the.
Do you want a daily or?
I don't mind it, just on a slower time frame, and then how.
Okay. Just put the gold up. Just move that over to. Where do you want to go? Daily. We do write about gold quite frequently, and we get flamed for it because we just call it as we see it, and that's not what the gold bugs want to see. But there we go. It's pretty bearish at the moment. You can see the trend monitor is pretty much bright red across the entire screen. Coming back to the VPA situation, this is obviously a future. This is the GC contract, it's the gold contract. This is a big contract, and just going off piece for a moment, just going to MT5. MT5 is a fantastic route into all these markets, because if you're trading an ES contract or a YM contract, a true futures contract I'm talking about now, they are massive in terms of the margin requirements. To trade a YM, you're going to need several $1,000s, and the ES is huge. Furthermore, to trade a gold contract, several $1,000s of margin. That's with one contract. There are micro contracts available, but that's why the MT5 platform is great. So if you want to trade gold or silver or some of the soft commodities or the indices indeed, and stocks, they're all there. All right, the stocks are a little bit more limited. Obviously on here you've got thousands to choose from. In terms of an MT5, less so. I think one of the questions was about using the indicators on Ninja or MT5. I don't know whether you've answered that one, darling, or not. You've done all that. Okay, fine. But again, nice examples here of VPA in action. I'll just take them straight off the top of my head. If you look at this rally here, very bearish. This is self-evident. We've got a widespread down candle, no wicks, ton of volume underneath, heavy selling, and this is futures. So, that's the futures contract being sold very heavily. We then see this rally, this attempt to rally by gold. Is it going very far? Answer, probably not. The first one looks okay. Decent volume under that, decent candle. Okay, we've got a wick to top and bottom, but nothing dramatic. The next candle's a bit of a giveaway. Ton of volume, much higher than the previous day. Absolutely narrow spread on that, not really going anywhere. And again, you would start to bring in other aspects like support and resistance. We've got some relatively minor resistance here, but nevertheless, we've got resistance. We've got price resistance here, and we've got resistance on the accumulation distribution indicator. Up we go. This doesn't look very strong, not very encouraging. Down we go again. Rising volume under this candle. Another widespread down candle on solid volume. Again here, same again. Interestingly, on this day, we actually see some buying coming into the market. Why have we got buying? Because we've got a deep wick to the lower body, and the market has fallen quite steadily throughout the session, or maybe it was early part of the session, I can't remember. And then in comes the volume buying. So we've got lots of volume under here, and we've got a close pretty much back near the open. So we've got a little hammer candle here formed, decent, very good volume, and a wick to the underside. Does this mean that is enough to reverse this market? The answer is probably not. What it does mean is that the prospect is that we're going to see possibly some bullish sentiment coming into gold if it follows through, but then you've got to see that follow through. And then as we flip-flop around in this area, we've got resistance overhead here, just above the 1230, 1232 area. And you've got falling volume. You know, the market's trying to rally, but the volume is falling away. What does that tell you? It tells you that you know, the big operators are not buying into this move. They're not interested in buying gold. And all the drivers for gold, yes, it's going to get driven around by obviously dollar, and primarily it's going to get driven by inflation, which is severely lacking across the markets right now. So until inflation picks up and gold then sits in its traditional place of being a hedge against inflation, then you know, it's not great news for gold bugs, I'm afraid. Sorry if you are a gold bug, but you know, it's just the way it is right now. And we've got some other markets down here. I've got wheat down here and soybean. And really just to make the point again, I mean, this is a soybean chart. You've probably never traded soybean. Maybe not even know what it is, but it doesn't really matter because obviously you need to know the fundamentals and the drivers for that particular market. But from a volume perspective, all you're interested in is the volume. And the reason we've got this huge increase in volume here is because, as always, with any index, any commodity, as you come into the US session, you're going to see a massive pickup in volume because all these markets run electronically now. So this is run on a platform called Globex. It doesn't devalue volume because volume is relative. But what happens is at the crossover session here, you can't compare this volume with that volume because you're trading a different session. So you have to allow the market to settle. But if you were trading this electronically on Globex, perfectly fine, because you're comparing light with light. You're comparing this volume with this. These look tiny here. But rest assured, if we took this away and this was running in Globex on a 24-hour basis, you would see decent volume and the ability to compare like with like. Do you want me to pass back to you, darling?
No, I think we're going to wrap up there because we've got a lot of spiel to do. Sorry, is someone, Sudhir, is he a customer? He's on MT4, isn't he?
Yep.
I have the quantum installed.
Okay.
Work for MT5.
Okay.
I need a separate installation package. So I was going to, do you want to?
Yeah, I can answer that one on air. Yeah. Sudhir, let me answer that one on air for you. In fact, the previous question also is about MT5. Okay, MT5 is increasingly becoming available. There are all these rumors about MT4 being phased out. Whether that happens or not, who knows? But the fact is that MT5 is gaining in traction, partly through changes that MetaQuotes have made to the platform to improve it for various markets, particularly Forex. But they are also keen to move a lot of their customers onto MT5, and you'll find brokers now increasingly offering the package. Now, I know MT4 can be an issue for US customers, so MT5 is certainly one option to consider. I know parts of the world where MT5 is the only allowable platform. MT4 is banned. I think it's in Brazil, I'm not sure, but from memory, I think it is. So do check out MT5. In terms of your question, Sudhir, about the quantum indicators, will they work on MT5? Yep, we give you full access to the indicators through the quantum dashboard, so you can transfer them quite easily from MT4 to MT5. That you can do for yourself. And I think someone asked a question earlier on about using them for NinjaTrader. Which would we suggest? What do we recommend? It's a very different approach. NinjaTrader is a powerful platform. It's very US centric in terms of stocks, for example, for stock markets and indices. So you tend to find that you will need to pay for a feed. We recommend the kinetic feed. Thereafter, it's pretty much the same with MT5. What are the differences? Well, with MT5, you've got a much broader array of timeframes. With NinjaTrader, you've got anything you like. And you do clearly with NinjaTrader, you've got access. If you want to trade true futures, as I said before, then you would need to go the NinjaTrader route. But that comes at a price. So unless you want to trade true futures contracts, unless you want to trade heavily in US stocks per se, then I would suggest that MT5 is a great route into commodities, indices, and stocks at a much, much, much lower price. It's far less risk. You'll be risking far less capital, but you'll be trading essentially the same markets. So, but it also brings me on to another point that as a company, what we offer is all our customers have the option to transfer from one platform to another at any time. And it doesn't matter whether it's one indicator or the whole 9 yards. There's no cost involved, because what we find is that customers maybe start with MT4, they move to MT5, and then maybe they want to migrate to NinjaTrader. And we've got other platforms in the pipeline. We're looking at TradeStation and TradingView. We understand that traders, their knowledge and experience and expertise and the markets they wish to trade changes over time. So there's no restriction. It's very flexible. As I say, MT4, MT5 is very easy. In terms of moving to NinjaTrader, it's just a transfer of a license, and we just do that for you, and we just disable it on the MT4-5 side, and we enable you over on your NinjaTrader side once you've got your platform up and running. Okay. Just going to switch off for a moment. Grab a drink.
Oh, you don't want this one on?
Yeah, no, that's fine. Just to wrap up, because we're coming ahead at overtime, so apologies for that. Just to very quickly go through the details of the indicators. You can find all the details over at quantumtrading.com. As I say, you've got the MT4, MT5, and also NinjaTrader. You can buy one indicator or the complete package. We treat you as a customer in exactly the same way. So whatever you spend with us, whether it's for the smallest indicator or whether you have the complete package, you get the fantastic support in which we pride ourselves on in terms of a company. You also only ever pay once. You own the indicator for life. You never pay us any more. That's it, job done. So there's nothing in support fees, nothing in upgrades, nothing else. And just to really make the point that, as I say, it's 24/7 support. It's 365 days of the year. And yes, we even answer emails at the weekend. That's what the guys do. And that's what we believe in, because we have traders around the world. So, even if you email us at the weekend, you will get a reply, and it's very, very quick. It's normally in a matter of minutes, but that's the sort of support we offer all our customers. As I said, it includes all upgrades, enhancements. You never pay for anything else. We are constantly getting upgrades in terms of platforms. We have to update the indicators to make sure they're compliant. You don't pay for that. We do all that. We take the pain of doing that all the time. NT7 up to NT8 was a massive undertaking for us, but we did it because we do it for our customers. That's what we do. As I said before, you can transfer your license from a platform to platform at any time. It's entirely free. It doesn't matter if you've got one license or whether you've got the full set. That's what we offer. Just to wrap up very quickly on the next one, and this is unique, no other company that we know offers this. If you invest in the full package, you get all future indicators free of charge. Customers who've been with us for 4 or 5 years, I think we started with 9 or 10, we're up to something like 16 or 17 now. They haven't paid a brass cent for those. They've just had them added to their user dashboard. That's what we do. It's our way of saying thank you. And that also applies whether you invest paying outright or whether you pay on the easy payment plan. Most of our indicators are all available in terms of 3 monthly payments. The lower price ones are not, but certainly most of them are available as a payment option. We're always happy to credit you if you want to upgrade to the full package, or you want us to move across the QT program. Just drop us an email. And if you've bought 1 or 2 indicators and you think, I love these, I just want to upgrade, I want to go this route, that's fine. We'll give you a credit for those, no problem at all. And if you do want to run a second license, you want to run 2 machines in parallel on different accounts, then we just charge 50% of the first. And finally, just to wrap up on the education program, you can find all the details over at quantumtradingeducation.com. We believe it's the most comprehensive education program anywhere. It's available for MT45 or for NinjaTrader. And in that program, you get the full suite of quantum indicators, which effectively means the education, which is so comprehensive, is unbelievable, is only $497 in total. So in an MT45 education program of $1391, you're getting $894 for all the indicators, and then just $497 for the education on top. And that's including over 50 hours of video. There's video podcasts, there's 13 PDF downloads. And as Anna said, there's also the Trader Chatter, which is now on River, which I think everyone is loving again. That's it. I think we're done. Oh, any more questions? No, that's it. Okay. Yeah, I'm just going to pass back to Anna, because you've heard enough of me for today. So thanks a lot from me for your coming along today. Hope you've enjoyed it, and we will see you next week. I'm just going to pass back to Anna.
I just wanted to say thank you to all of you who've actually put the questions in. I know we were going to keep it to the end, but they were coming through, so I did them. So some great questions about MT5, feeds, kinetic. I hope you caught the answers that I had there. Those of you who've got the books, thank you so much for buying the books, and thank you for your very, very kind words. I have some fantastic emails from traders saying that the books have truly, been life-changing, and life-changing in the sense, for me, the greatest pleasure for me is to hear from traders and investors who perhaps have struggled to make headway in this very difficult and tricky market, and suddenly sort of having the scales drop from their eyes and they become successful. They get the success that they deserve and that they want, and that gives confidence. A little bit of success is what we need. I know we learn from failure, don't get me wrong, we have to fail, we have to learn to lose, but boy oh boy, sometimes it's wonderful to have a little bit of success, build that confidence and move forward. And as I said, the books now, there are the example books as well up on Amazon of VPA examples. And as I said, and if you've not come across this methodology before, and you certainly the indicators are perhaps a step too far, just spend $10 on Amazon. That's all. I think they're $4.99. It's the basic book and then the examples book. There are traders out there who are quite happily trading with just those 2 books, and they discover for themselves what works for them. Because once you understand what we said right at the beginning, what is this chart telling me at this particular moment? Where am I in this price cycle? What is happening? Then I can develop some tactics for me to take advantage, because I know what is likely to be happening next. So therefore, that's all I've got to say. David is waving goodbye. What's that? Oh, the Aussie dollar. Oh, yeah. Well, the next time we'll put together some different charts. We'll look at different aspects of the price cycle. If you've got any questions, you can about what you've heard today, or you want further information, you can write to me, Anna at annacooling.com, or helpdesk@quantumtrading.com. One of the guys there will get back to you ASAP. So enjoy the rest of the trading day, and we will catch you next time. Take care.